Silver, $79 to $84. Oil hit 120, crashed to $100. G7 crisis response. Silver crashed, then clawed back. Oil exploded to $120, then collapsed. And somewhere in a closed room, G7 leaders called an emergency meeting, not a scheduled one, an emergency one. 3 markets, moving violently. At the exact same time, this is not coincidence. This is not a correction. Something much larger is being quietly decided without your knowledge. And by the time mainstream media explains it, it will already be too late. Welcome to Financial Crisis. Explained, the one place where the numbers tell the story that no one else is reading out loud. Now, before we go any further, if you have been watching this channel for some time, you already know what we do here. We do not guess, we do not hype. We read the structure, and right now, the structure is speaking very loudly. Now, a small request, and I want you to think of it the way a wise elder thinks about leaving something behind, something valuable, for those who come after. If you have lived long enough to watch economies rise and fall, if you have seen booms and busts with your own eyes, then you already understand knowledge, when shared, multiplies. Subscribing to this channel is not clicking a button. It is choosing to stay informed in a world that profits from your confusion. So if no one has asked you lately, subscribe for yourself, for your family, because what we discuss here affects every single one of them. And one more thing, before we begin this briefing, drop your location in the comments below. Where in the world are you watching this from right now? Because this story does not belong to one country, it belongs to all of us. Now, let us begin. It happened on a Sunday, not a Tuesday, not a Thursday, a Sunday. When most of the world was asleep, when families were at breakfast tables, when markets were just opening their eyes, silver dropped. Not slowly, not gently. It fell off a cliff. From $84 down to $79, a $6 flush in the opening hours of the week. Now, to someone who does not study markets, $6 sounds like nothing. But to anyone who understands how silver moves, how it breathes, how it behaves under pressure, that $6 drop in the opening hours of a Sunday session was not a dip. It was a message. The question serious analysts were asking was not, why did silver fall? The real question was, who needed it to fall, and why right now? Because in modern commodity markets, prices do not move violently without a reason. There are desks, algorithms, institutions that apply pressure at specific moments to achieve specific outcomes. A Sunday open flush is a classic mechanism. It shakes out the weak hands. It triggers stop losses. It creates fear in retail positions. And it does all of this before the serious money moves in the opposite direction. And that is exactly what happened. Silver did not stay at $79. It clawed back every single cent. By the time serious traders were at their desks Monday morning, silver was sitting right back at $84, a complete recovery. And here is where the story becomes structurally significant. Because $85 has now rejected 4 times. 3 times on Friday, once again after the Sunday flush. In technical market analysis, when a price level rejects once, it is noted. When it rejects twice, it is respected. When it rejects 4 times, it is no longer just a technical level. It becomes a structural ceiling. Something above that price does not want silver to pass. Now consider this carefully. During that same window, the US dollar gapped higher at Sunday's open. A stronger dollar typically pushes silver down. That relationship is well documented. But here is what the mainstream analysts missed entirely. The dollar came back into its gap, meaning dollar strength faded, and silver still could not close above $85. Let that sit for a moment. Dollar weakened. Silver still rejected. That is not a dollar story. That is a structural story. Something beyond currency movement is holding silver beneath that ceiling. But the most important data point of this entire session did not come from New York. It did not come from London. It came from Shanghai. Shanghai closed physical silver at $96.85 that same day, up 1.7% on the session. While Western paper markets were engineering a flush, while algorithms were pushing silver to $79, buyers in the East were paying $96.85 for real physical metal. That is a $12 gap, $12 between what Western paper contracts claim silver is worth and what Eastern buyers are actually paying for metal they can hold in their hands, and this gap did not close. Not on a day when risk assets were being hammered globally. Not on a day of maximum financial stress, the gap held. Now look beneath that price gap and examine what is happening in the vaults. Shanghai Futures Exchange, silver vaults, shed another 3 metric tons that Monday, down to 8.1 million ounces. Despite violent price swings through late January and February, despite weeks of market turbulence, no meaningful new metal has arrived to replace what has been pulled. Physical silver is leaving the system, and it is not coming back. Here's the strategic reality that every serious decision maker must understand. You can manage a paper price, you can push numbers on a screen, you can flush a market at Sunday Open, but you cannot fabricate a warehouse receipt. You cannot print physical metal. And when the vaults are emptying, while Eastern buyers are paying $12 above Western price, while a structural ceiling holds silver below 85 baht, regardless of dollar movement, the market is not malfunctioning. The market is communicating. The price mechanism for silver is quietly, irreversibly shifting from paper-driven Western trading toward physical-driven global demand. And the speed of that shift is accelerating. This was only the silver signal, because while silver was sending its message quietly, oil was doing something far more violent, far more visible, and far more dangerous for the global economy. Silver $79 to $84, oil hit $120, crashed to $100, G7 crisis response. Forget everything the headlines told you about oil. Forget the analysts. Forget the talking heads on financial television, sitting in expensive suits, giving you numbers without context, prices without meaning, motion without direction. Because what happened to oil in this specific window of time was not a market event. It was not supply and demand finding balance. It was not a correction. What happened to oil was a controlled demolition. And the evidence is hiding in plain sight. For anyone willing to look carefully enough, let us start at the beginning. Oil climbed to $120. Not slowly, not gradually. It surged. The kind of surge that does not happen in stable systems. The kind of surge that only happens when multiple pressure points activate simultaneously. Geopolitical tension in energy corridors, supply chain bottlenecks that were never fully resolved, strategic reserve drawdowns that quietly ended without public announcement, and underneath all of it, a dollar system under quiet stress that was making every barrel of oil more expensive in real purchasing power terms than the nominal price was revealing. $120 was not just a number. $120 was a threshold, a level at which entire economies begin to buckle. Think about what $120 oil actually means in practical terms for the businessmen and entrepreneurs watching this briefing. Every product that moves by truck, every raw material that travels by ship, every factory that runs on energy inputs feels $120 oil, not immediately, but with a delay of approximately 6 to 8 weeks. That delay is dangerous because by the time the cost increase reaches the consumer, by the time it shows up in inflation data, by the time central banks begin responding, the damage is already 3 months deep. Businesses that did not hedge, supply chains that did not adjust. Entrepreneurs who were watching revenue instead of watching input costs were already behind. $120 oil does not announce itself politely. It arrives quietly in your cost structure and reveals itself loudly in your margins. And then, just as suddenly as it rose, oil crashed from $120 down to $100, a $20 collapse, in a time frame that left most retail investors completely disoriented, up violently, down violently. And the mainstream narrative immediately called it a correction, a relief rally reversal, profit-taking. But serious analysts do not accept surface explanations for structural events because a $20 drop in oil does not happen through organic market activity alone, not at that speed, not with that precision. There are only a limited number of mechanisms that can move oil $20 downward in compressed time. First, coordinated strategic reserve releases, governments unlocking emergency oil supplies to flood the market with short-term inventory and artificially suppress the price. Second, forced institutional liquidation, large positions being unwound not by choice, but by margin pressure, or by direct instruction from entities that operate above the level of normal market participants. Third, a deliberate geopolitical signal, a message sent through the price itself to specific producing nations that the consuming powers still retain the ability to engineer price direction. When the political cost of high oil becomes unbearable, all three mechanisms leave the same fingerprint, a spike that moves too fast for fundamentals, followed by a crash that moves too clean for organic selling. This was not chaos. This was choreography. And here is where the oil story connects to something far larger, because $100 oil is not cheap oil. $100 oil is still, historically, crisis-level pricing. The relief that markets felt when oil dropped from $120 was psychological relief, not economic relief. A consumer economy does not breathe freely at $100 oil. It simply suffocates more slowly. And slow suffocation is actually more dangerous than a sharp shock, because it does not trigger emergency responses. It does not activate the urgency that structural problems demand. It allows decision makers to convince themselves that the situation is stabilizing, while the underlying pressure continues building silently beneath the surface. Now connect the two signals together: silver sending structural warnings from the vault system, oil executing a violent round trip. That bears the fingerprints of coordinated intervention, two of the most critical commodities on the planet, moving in ways that defy simple market logic, within the same compressed time frame. When two signals speak simultaneously, the serious analyst does not study them separately. The serious analyst asks, what single force is large enough to move both markets at the same time? The answer to that question was not found in a trading terminal. It was not found in a Bloomberg report. It was found in a closed room where 7 of the most powerful economic nations on Earth sat down together, quietly, urgently, and called it an emergency. What was said in that room, what was decided, and what it means for every serious decision maker watching this briefing is exactly where part 3 begins. Silver, $79 to $84. Oil hit $120. Crashed to $100. G7 crisis response. There's a particular kind of silence that precedes a very important decision. Not the silence of peace, not the silence of stability, the silence of men in expensive rooms who have run out of comfortable options and are now choosing between uncomfortable ones. That silence descended over the G7 table this week. And what most of the world saw was a press release, a carefully worded statement, measured language, diplomatic tone, reassuring phrases designed to project confidence to an audience that was already nervous. But what serious analysts read was not the statement. They read what triggered the statement. Because emergency meetings are not called to celebrate good news. Understand the architecture of the G7 first, because context matters enormously here. The group of 7, United States, United Kingdom, Germany, France, Italy, Canada, Japan. These are not simply 7 wealthy nations. They are the institutional core of the post-World War II economic order, the system of dollar reserve dominance, the framework of Western financial infrastructure, the network through which energy is priced, capital is allocated, and economic pressure is applied to the rest of the world. When this group meets on schedule, it is governance. When this group meets off schedule, when the word emergency appears in the briefing notes, it means the architecture itself is under stress, not a department, not a sector, the architecture. So what exactly triggered this emergency convening? The public answer is oil prices, and that is partially true. But partial truths in geopolitical economics are more dangerous than complete lies because they direct your attention precisely where the important story is not happening. Yes, oil at $120 created political urgency. Fuel costs affect votes. Inflation affects approval ratings. Energy prices determine whether populations remain manageable or become ungovernable. Every leader at that G7 table understood this arithmetic perfectly. $120 oil was not just an economic problem. It was a political survival problem. And political survival has a way of accelerating decisions that economic rationality alone would deliberate over for months. But beneath the oil price headline, 3 deeper conversations were happening simultaneously. In that closed room, the first conversation was about the dollar. Dollar strength had been used as a tool to suppress commodity prices for longer than the system could sustainably support. A strong dollar makes oil cheaper in nominal terms. A strong dollar suppresses gold and silver paper prices. A strong dollar exports inflation to every emerging economy that holds dollar-denominated debt. But dollar strength has a cost. It hollows out American export competitiveness. It creates currency crises in allied nations. It strains the very relationships that the G7 framework depends upon to function. The dollar conversation at that table was not about strength or weakness in isolation. It was about how much longer the current trajectory could be maintained before allied fractures became visible to the public. The second conversation was about energy architecture. $120 oil did not arrive randomly. It arrived because the energy transition that Western governments publicly committed to created structural supply vulnerabilities that traditional energy producers were quietly exploiting. You cannot simultaneously defund hydrocarbon infrastructure, announce the end of fossil fuel investment, restrict domestic drilling and refining capacity, and then express surprise when energy prices become a geopolitical weapon in the hands of nations that never stopped drilling. The G7 leaders at that table were not debating climate policy. They were managing the consequences of climate policy, meeting the reality of energy dependency in real time with very limited options available. Strategic reserve releases were discussed, emergency supply coordination between member nations, temporary price caps on specific energy categories, and the uncomfortable acknowledgement that some of the supply solutions available required conversations with nations that Western foreign policy had spent the previous 3 years deliberately isolating geopolitics as a way of becoming very flexible, when the alternative is economic collapse. The third conversation was the one nobody will report. It was about the physical commodity system, because the silver vault data from Shanghai, the $12 gap between Eastern physical and Western paper, the steady depletion of COMEX inventories, these were not invisible to G7 financial intelligence. These signals were in the briefing documents. They were on the screens of the analysts who prepared the materials for the people sitting at that table, and the conversation they were having was not whether the commodity price mechanism was shifting. It was how fast. Because if the shift from paper-driven Western pricing to physical-driven Eastern demand reaches a critical threshold, the dollar's role as the default global commodity pricing currency comes under direct structural challenge, not through military conflict, not through political declaration, but through the quiet, relentless, unstoppable logic of where real metal is moving and who is paying real prices to acquire it. The G7 response that was announced publicly, coordinated strategic reserve releases, energy price monitoring frameworks, currency stabilization language, was not a solution. It was a tourniquet applied to a wound that requires surgery. Tourniquets buy time. They do not heal the underlying damage. And the most important question for every serious decision maker, every entrepreneur, every business person watching this briefing is not what the G7 announced. The important question is, what does the time they just bought actually get used for? Because history is very clear on what happens when emergency responses address symptoms, while structural causes continue operating undisturbed. 3 signals have now been read: silver, oil, G7, each one serious on its own. Together, they form a picture that demands a response, not of fear, but of strategic preparation. And that preparation is exactly what Part 4 delivers. Silver, $79 to $84. Oil hit $120, crashed to $100. G7, crisis response. Everything covered in this briefing so far was not history. It was not theory. It was not academic analysis designed for lecture halls and published journals and conversations that never leave the room. Every signal discussed, every data point examined, every structural pattern identified is happening right now, in real time. And real time demands real decisions. Not tomorrow, not after the next earnings report, not when the situation becomes clearer. Because by the time situations like this become clear to the general public, the window for strategic positioning has already closed. Understand something fundamental about how serious wealth is built and serious wealth is protected during periods of structural economic stress. It is never built by those who react fastest to breaking news. It is never protected by those who panic first or panic loudest. It is built and protected by those who develop the ability to read structural signals before they become headlines. Silver at $79 to $84, with a $12 gap between Eastern physical and Western paper, is a structural signal. Oil executing a violent $120 to $100 round trip, with the fingerprints of coordinated intervention, is a structural signal. A G7 emergency meeting, applying a tourniquet to wounds that require surgery, is a structural signal. 3 structural signals activating simultaneously is not coincidence, it is a pattern. And patterns have historical precedents that serious decision makers study carefully. 1973, the Arab oil embargo, oil prices quadrupled in months. Western economies that had built entire infrastructures around cheap, accessible energy found themselves suddenly exposed to a vulnerability they had always possessed, but never seriously addressed. The businesses that survived that period were not the ones with the most capital. They were the ones that had quietly diversified their energy dependency, reduced their input cost exposure, and positioned in hard assets before the embargo made those decisions obvious to everyone By the time it was obvious to everyone, the positioning opportunity had expired. 2008, the global financial crisis. The signals were present for 18 months before the collapse became public knowledge. Mortgage delinquency rates rising quietly, credit default swap volumes expanding abnormally, interbank lending rates beginning to fracture in ways that did not match the confident public statements of the institutions involved. The investors and businesses that protected themselves were not the ones who predicted the exact date of collapse. They were the ones who read the structural deterioration, respected what it was communicating, and made decisions based on signal, rather than waiting for confirmation. Confirmation in a structural crisis always arrives too late to be useful. 2020, supply chain collapse, currency expansion, commodity repricing. Every business that had concentrated its supply chain in a single geography learned an expensive lesson. That diversification is not inefficiency, it is strategic insurance. Every individual who held exclusively paper financial assets watched purchasing power erode, while those who held real assets, hard commodities, energy positions, productive infrastructure, watched their relative position strengthen, not because they were lucky, because they understood that when central banks expand money supply at emergency speed, the value of everything denominated in that currency, measured against real physical things, moves in only one direction. Now bring those three historical moments into contact with the current signals, because the parallel is not perfect. Parallels never are, but the structure is recognizable. A commodity system under physical stress, and while paper prices attempt to maintain a fiction of stability, an energy market being managed through intervention rather than fundamentals, buying time rather than solving problems, an institutional emergency response that addresses the visible symptom, while the underlying cause continues operating undisturbed. This structure has appeared before, and those who studied it seriously know what typically follows. So what does the strategic playbook actually look like for the business people and entrepreneurs watching this briefing right now? First, audit your input cost exposure immediately. If your business model depends on energy costs remaining at current levels, you do not have a business model. You have a bet that intervention will continue working, a bet that the tourniquet holds. Serious businesses do not run on bets. They run on hedge structures that can absorb cost increases without threatening operational continuity. Review every energy-dependent cost line. Identify which ones can be contracted forward. Identify which ones can be reduced through operational adjustment. Do this now, not next quarter. Now. Second, understand what the East-West commodity gap is telling you. The $12 gap between Shanghai physical silver and Western paper silver is not just a precious metal story. It is a story about where real value is being recognized and where paper representations of value are beginning to diverge from reality. For entrepreneurs and business builders, this gap is a directional signal. The global economy is in a slow but structurally significant reorientation of where pricing power lives. Businesses that build relationships, supply chains, and financial structures that acknowledge this reorientation will find themselves on the right side of a very long-term shift. Businesses that ignore it because it is inconvenient or complex, or because the mainstream has not confirmed it yet, will spend the next decade wondering what happened to their margins. Third, separate the tourniquet from the treatment. The G7 response bought time. Acknowledge that. Do not mistake it for resolution. Strategic reserve releases are finite by definition. Price caps create supply distortions that always resolve violently. When the cap is lifted, currency coordination between nations with increasingly divergent interests has a shelf life that is measured in months, not years. The window of relative stability that emergency interventions create is not a signal to relax. It is the most valuable time a serious decision maker will ever have. Use it to build structures that do not depend on the intervention continuing, because it will not continue indefinitely. Nothing artificial ever does. Fourth, position in the direction of structural reality, not in the direction of managed appearances. Structural reality says physical commodities are tightening. Structural reality says energy dependency is a strategic vulnerability for nations and businesses alike. Structural reality says the institutions managing the situation are applying emergency tools to problems that emergency tools were never designed to permanently solve. The direction of structural reality is not a prediction. It is a reading. And serious decision makers do not bet against structural reality, regardless of how convincingly the managed appearance suggests otherwise. Three markets spoke this week. Silver spoke through its vaults, through its $12 gap. through its 4 rejections at $85. Oil spoke through its violent round trip, through its choreographed collapse, through the $100 floor that offers psychological relief without economic resolution. The G7 spoke through its emergency convening, through its tourniquet language, through the 3 conversations that happened behind the press release. Together, they are saying something that does not require translation. For anyone willing to listen carefully, the system is not broken, but it is bending. And the distance between bending and breaking is measured not in time, but in decisions. The decisions made by serious people in the next 60 to 90 days will determine which side of this structural shift they find themselves on when the bending finally stops. This has been Financial Crisis Explained. Read the signals. Respect the structure. Position before the confirmation arrives, because by then, the playbook will already be written.